Hello, everyone. Welcome to Market Trends. I'm David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. We continue to experiment with our new live streaming on YouTube. So I want to just welcome everyone who is to our regular Thursday webinar. I'm now going to just show some disclosures very quickly. We like to look at all the different things that TradeStation can do for us, the different kinds of functionality it has, and do that in particular to find opportunities in the market and to really identify and discuss some of the trends that are out there. I wanted to just make sure here that everything is going correctly. Make sure this is streaming as it should. And it looks like we are now live. And that is great. All right, so thank you everyone for being with us. Now, if you go to tradestation.com and you go to Insights on the top navigation bar, it'll take you to a blog post with the key talking points that we're going to have for today. Very good. So first, let me just share this, some information with you guys in the comments. These are just some of our disclosures and other things that you can look at. Now, if you're on tradestation.com and you go to Insights, it will bring you to our Market Insights blog. From here, you click on this. This is the rundown for today's webinar, and we're going to be going through these key points today. So first, I want to start off as I usually do by looking at the S&P 500. And this chart to me is really the thing that I'm focused on right now. This is basically the daily chart of the S&P 500. You can see some levels on here. So if I actually kind of, I'll go here and I'll zoom this up and change it to a daily. And to me, the big thing is, I don't have it drawn on here, but there's a trend line running across here. You can see it in the blog post. I have some other levels identified based on, the bottom, in my opinion. If you look back to we had a big bearish outside day back in July when that was a strong GDP report. And this level now, the bottom of this, is a potential sort of support level. There's a lot of little areas, if you look across here, where a person could be trying to draw support or resistance. And, in my view, it's kind of difficult to really make a big deal of a lot of this when the market is extended like this. And at the same time, when the underlying macros continue to get much more positive like this. I think it's important to remember that we had a massive change in sentiment earlier this month. It went from widespread bleakness to a growing sense of confidence that the Fed is done raising rates, that the inflationary problem is over. And in many ways, when people look at where the market is right now, it's one of these things where there's not likely in a scenario like this of there being a lot of selling. The potential of people quickly taking profits after the market had a rally like this. I mean, we are now sitting at one of the best months in the last decade, depending on how exactly we finish in the next 2 hours. It could be the best since I think it was July of 21 versus you got to go back to March of 2020. I mean, it's a half percentage point one way or the other in terms of the ranking of the month. So the key thing though is this was a big thrust of change in sentiment, of money coming in, and long-term people starting to think, this uptrend could be resuming. And I think it's important to remember, and we've talked about this in the weekly chart of the S&P, historically, we have these periods of about 20 months of consolidation, like back here in 15 and 16 with the breakout after the Trump election. Then we had basically this period where it got ahead of itself in early 18 and it moved sideways. And then it broke out after the trade war ended. And, if it hadn't been for COVID, that probably would have continued. But now we have another period of about 20 months. So this uptrend, and also if you go all the way back to 2012, we had the same sort of situation where the market broke out right after Obama got reelected. So basically, the market has gone through these periods of roughly 20 months of consolidation and continuation. And I think right now, we're in a process of something similar potentially happening. And when you look at this falling, sort of trend line here, this is pretty important. This is the trend line that started way back here, at the high immediately before the bear market started, runs along this high here, and then we also have various levels of resistance through here. So from my perspective, this is a period now where in ways it's less about levels and probably more about time, simply sitting here churning, having a few days and maybe a week or two of zero return, down 0.5%, things like that. And in many ways, where I think really is the story now is not just the S&P, what's happening beneath the surface. And today we're going to have a special sort of analysis, or not analysis, but a kind of guidance of how we're going to can start to find some of these new areas that are doing well in this new sort of environment. So let me just put this back. This is supposed to be an hourly chart. It's part of our ES workspace, which is a special workspace that is designed for trading the S&P. And I think, right now, for people trading the index, it might be kind of a boring time. Times like this, when you get a big significant thrust like this, you usually have a period of tightness and relatively small moves. However, from people looking at it purely based on technicals, I will note that this is actually a potential buy signal we have right here, because what we see, and this is something we've explained before, there's 3 indicators on this hourly chart of the futures. And what it does is the stochastic is oversold, but the 50-hour moving average has mostly been rising. I mean, it's this green line here. It's the average. I mean, it goes slightly negative here. But when you look at, this sort of these levels across the bottom here, this would be a spot where, based on this, method that we've used in the past of stochastics being oversold, and a history of a rising 50-hour moving average, would favor potentially looking for continuation to the upside at this point. If we look here in the hourly, I mean, we can also see this is a high basing pattern, and we've seen this before. When the market is, in something of a bullish move, you get these high basing patterns. You don't get much of a pullback, and I think that's really what's interesting here, is that the tightness of this move has been pretty interesting. If we also look back to where we were back, when the market started rallying out of a similar negative sentiment back here in May, we also saw that we had these relatively tight periods of consolidation here, and we saw something similar right here. So from my perspective, this is pretty interesting to see. There was a really important support level here that we didn't even touch. And we've basically managed to break through a lot of resistance here. I had said at the time that, in my view, the other trend line that was really important, we blitzed through, and we've behaved as I expected since we broke it, which is basically, I had kind of said that when this trend line breaks, which was the trend line on the intermediate term time frame, which is a kind of 3 to 5 months, once we broke that it would be continuation to the upside. Now we're looking on the longer term, which is like 6 months and longer in the way I define things. And if we go now, make this as a weekly chart really quickly, we can see, like I said, this trend line. Now we can take this trend line, and this is the one that is now important. And we're pushing against that. And this is a longer term one. And so from my perspective here, this is what we want to focus on. And this market would tend to follow a period of just kind of tight consolidation here without a lot of action on the index, just kind of churning and putting in our time before there's the potential for some continuation. And there will be some things like that. Next week, a week from tomorrow, we're going to have non-farm payrolls. The following week after that is the big enchilada, though, because on the 12th, we have CPI, and the 13th, we have the Fed. So from my view, in many ways, that's really our big North Star now, our big sort of, calendar events to be kind of focused on. And the other big thing we're going to be focusing on today in this webinar is inflation and CPI, because there's some really interesting stuff kind of happening. So I think just looking here at the overall situation, the market is up now, I think, 5 straight weeks, which is, let me see, I had some points in here. 5-week winning streak is matches similar runs. It's pretty unusual to see a streak of more than 5 weeks. Happens occasionally. The last 6-week streak was October and November. What does that mean? It means that we could actually maybe see. It's interesting now. Is this, look, now it's no longer a winning streak. Now we actually are negative on the week. So what's interesting is, if you look at the way this market's behaved, look on a daily, basically we had like a 7 or 8 day winning streak, one red week, one red candle continuation. If we have a red candle on the weekly and we just kind of hold, that might start to kind of, satisfy the the idea of a pause and a pullback, and just one or two slightly negative weeks could be enough to make people start to come back. So I think it's interesting just to see this. The fact that we're now negative on the week is actually something that might give more opportunity as we start to look into next week and we start to think about the payrolls number a week from now. All right, let me just move on with this. The key thing to me, though, is in many ways is that basically we have an overbought RSI, which I don't have on this chart, but the RSI has gone into an overbought condition, which also means, people looking for something could be looking for something of a pause. And then the other thing, though, is that the VIX has really collapsed here. And from my view, we did an article earlier in the week. If you actually look, it was our Monday story about how the VIX had really kind of gone back to levels from before the pandemic. And in my opinion, in many ways, I would just say maybe want to read this article, because I believe that this was an important sort of thing that really happened. People basically, when we had COVID, the Fed basically gave us like a medicine. It's like if you're like sick and you get some injection of medicine that keeps you alive, but then the medicine has a side effect that then you need to overcome from. Well, we did. That medicine that kept us alive in 2020 caused the side effect of inflation in 21 and 22. And now the side effect is fading. And in my opinion, the reason why the VIX has stayed high throughout this period, or at least until recently, the reason why was that basically, people were waiting to see the side effect of extreme money printing go away. And I think that in many ways, that is what we're now seeing. We're now seeing that the side effects of the life-saving medication are fading. And now, things are going back to normal. And the normal we're going back to is actually a very interesting normal. Because like I've said before, we had globalization that sucked jobs and GDP out of our country for years. You can see that on the trade numbers. It's there in trade to GDP. We also had the housing crisis, which killed a big chunk of our economy for an entire decade. Both of those drags on the economy that have been structural drags on our economy for 10 to 20 years are also going away. So we are coming out of this injury, so to speak, of COVID, and we're coming into an environment which is secularly and structurally more bullish and more positive than we have really seen since the early 90s. And that's why I think also it's so important to kind of compare this back to 95, the soft landing and the potential for a continuation of money coming into the market as those fears go away. And the other thing is that also at that point in time, you saw extreme negativity. Now I'm talking the AAII, American Association of Individual Investors survey. I'm not going to get into that this time around, but it is something that that we have done before. And if you look at, there is that dramatic sort of swing. All right, so good. All right, let me just get on these other things. Now, you can Google Cleveland Fed, or just Google right now, inflation nowcast, now CAST. Look at this. All right, the Cleveland Fed has running data. It looks at gas prices and all these other things. We're looking at another zero print on CPI on the 12th. That's what the market is saying. This is not me. This is the Federal Reserve. And we don't yet have, at least I've not been able to find any consensus estimates yet from the economists. But this is interesting because last month, the consensus number was pretty close to the nowcast. So you got to think these guys use similar models. This is a big deal because if people are realizing, wow, we're going to have another month of 0% inflation, 2 months in a row, the narrative increasingly moves in that direction of the improvement. All right, so let's actually look at some of these points in here because there's a lot of interesting things here that are really important in my view. So The Cleveland Fed nowcast. Now, in my opinion, there are three things happening all at the same time that I kind of see coming together. First of all, we have this ongoing trend in rents. All right, so here we have something from rent.com. It shows their month over month change in asking rents. And as you can see, it shot up in 2021 and it's been coming down since. So now we're basically flat for about a year, not a year, about since really more or less, kind of April. So again, as time moves on, it's going to become a thing when the trailing 12 months becomes more and more flat on a rate of change, and that means inflation goes down. So rents are something in there. And also the last CPI report had a decent slowing in shelter costs and in rent. So that is a big deal. It's interesting here, according to this website, which I think was rent.com, they're saying below normal demand, increased inventory. Now, we've been talking about this. The credit guys, the commercial real estate credit guys who retail investors don't read, they're boring sort of people. They have been warning for the last 8 to 9 months that we're going to have a glut of multifamily apartments in this country. So that will drag down rents. And I think that's an important thing to remember as well. And maybe in some ways, I'm not sure, but it almost seems like apartments might be kind of like oil, that the solution to high prices is high prices, and then people build more, and now next thing you know, you have too many apartments. Anyway, this is what rent.com is saying. They're saying year-over-year prices are negative in 3 of the last 6 months, which is pretty interesting, following 36 months of gains. This is what the beginning of a turn looks like. You go from being up, up, up to up, down, to then suddenly just being down, 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 down. So interesting to see that. The next piece. Now, shelter, if we look here, this is the CPI basket from the Bureau of Labor Statistics. If you Google, there's like a big spreadsheet and all this stuff. But basically, the key thing is more than 1/3 of inflation is shelter. So as that starts to go down, it simply becomes a drag on CPI. Next, energy. I have beaten the dead horse of energy a lot on this webinar. I've talked about the inundation of crude oil that is coming in, we're getting more evidence of that today. I'm just looking at this OPEC meeting, and I don't even know kind of what to make of it, but it more or less looks to me, well, I mean, this OPEC thing was, it just looks to me like they don't know how to do anything to support energy prices at this point in time. The American production continues to flood in. The Russians basically started flooding more oil into the market right before right before the meeting. But the key thing is that now we've dropped our sanctions on Venezuela and American production keeps going up. And from what I can tell, last night we had some more, maybe it's last night, maybe the night before, more weak data that came from China. And I continue to think that China is just, they have this weight of their debt blow up that continues to drag on them. And it's going to remain a deflationary factor in the background. And the oncoming, just the flood of oil entering the market and the lack of strong demand. There's a guy named Tom Cloza. And he basically said that oil demand show this, huge, he said the number is just, consistent with a recession. Now, it's not saying he's just saying that it's a big drop, saying gasoline demand plunges. Now, I'm not an expert in all the internals of the energy market, but everything I see basically confirms this idea that there's a lot of energy, a lot of inventory, and demand is fading or not super strong, not surging, whatever. But it just tells you, again, this is deflationary. That's the second part in the trifecta. And the third part is car prices. So this, in the last week or two, this is Cox Automotive. Wholesale used vehicle prices declined the first half of November. Remember the Manheim used car index? This was the crisis coming out of COVID when used cars were shooting through the roof and all that stuff. Well, this has been falling now for, over a year. And what's really interesting is, I'm just fascinated by some of the stuff I find on YouTube. Now, this is anecdotal evidence, but I found these guys named Ray and Zach. They run something called Car Edge. They seem to be a data vendor to car dealers, suggesting them how to, market cars and stuff like that. But they do some good stuff, and it's pretty interesting talking about the glut of inventory that car dealers have. And these guys are predicting falling prices. So for me, I don't just listen to one guy with the goofy stuff on YouTube, but when you see the data, last month we had the biggest drop in new car prices in a long time. We see this thing from the Manheim Used Index. We see anecdotal stuff. If you go on YouTube and you just Google, or you start looking on YouTube, used car prices, whatever, you're going to find videos like this. There's a bunch of people out there talking about this sort of decline. So I think it's, when you see a lot of evidence. So one of the drivers of inflation with car prices, energy, housing, all three of those now sucking lower. If you put those things together, you've got 35%, 7%. You've got basically half of CPI here that is looking in a spot when, you could see pressure to the downside. Walmart, CEO of Walmart, said we may be managing through a period of deflation in the months to come. He said this back on the 16th on their earnings call. It's better for our customers. So we may start to see blah, 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 grocery and consumables start to deflate in the coming weeks. Okay, so you put all that together, you look over here at this nowcast, and you realize something could be coming together here. And I think it's important to realize that, inflation is one of those things where once it starts, it has knock-on effects where basically one guy raises prices, then a month later, some other guy raises prices, and it becomes this cycle, this cascade. Well, the same thing happens the other way. As these prices start to come down, then suddenly Walmart says, hey, our costs are lower. We're going to start cutting prices. Then what happens to the other guy? They're all going to have to start cutting prices, and then it feeds the same way. And once you're at that turning point, that is what the Fed has been wanting to achieve, and it looks like that is what they have now achieved. And I think it's important to realize that no one's talking about it probably yet, but the 12th, we're going to get CPI, and we could have another zero print. So 2 months in a row of zero prints, it's going to be something. We enter the new year, and people could start to actually be talking about, wow, the stock market's not so terrible after all. Inflation is starting to improve. So I think it's important to realize that, this is a tailwind that it continues to develop. It's not, coming apart. So another thing that I thought was interesting is that this comes from the Fed. There was a series of articles this week. I believe the Wall Street Journal had it, but I saw it in some other places. This is money in money market accounts, which now hits a record. If you look here in our review, we basically showed that it was up like 75% since May of 2022 and 12% just since the summer. So there's a lot of money on the sidelines that can come into risk assets. So I think that's important to kind of, remember here. Another interesting thing popped up today. I'm not sure if I have it here. I feel like I missed it. All right, here's interesting. Eurozone inflation falls more than expected. Again, it's not the United States, but when you start to see inflation here, inflation there, they had inflation in Europe too. So it's like this is just one more piece of data that kind of confirms what I'm saying. So I'm going to close these so I don't get too. I want to just cover the ones I covered. The nowcasting, I'm done with this, done with Tom Plaza. So mentioning about oil, here's another interesting thing. So today there's an article that says, Brazil joins OPEC plus. So that's really nice of them. They're like OPEC, like Russia or whatever. Fine. But then back on the 27th, Brazil's biggest oil company says we're going to spend $102 billion boosting oil production. So, hey, with friends like that, who needs enemies? We're going to join OPEC, but we're going to crank out more oil than ever. So it just kind of shows that ultimately here, I think we have to remember that before COVID, OPEC was losing its power because of American shale production. Now, then there was COVID and they came together and they did massive production cuts and they prevented oil from going to like $10 or something. However, now that we're going back to this post-COVID reality, we're kind of back where we started, where basically Russia's like, They're going to be a friend to OPEC when they feel like it. And when they don't, they'll just produce all the oil they want. And now they've got basically Russia 2.0 in Brazil. Brazil's going to come in and be like, oh, yeah, we want to be part of OPEC, but at the same time, we're going to crank out more oil. So all these things suggest exactly what we were pointing out earlier in the month or last month, this article we did on oil, where basically we pointed out the fact that oil fundamentals were very much, coming apart. And this is what happens with oil. Oil is one of these things where you build, once it starts, you get a flood of production. We wrote this article back on the 17th of October and is played out as expected. So I think we got to just bear this in mind. This also creates a deflationary environment going forward. All right. That's Petrobras. I showed you the thing about Cox Automotive. What's this? I'm not sure why. Just about bond yields falling. I kept some different articles here, myrent.com. Here's another one. This is Kelly Blue Book. So, I mean, it's not just crazy guys on YouTube. It is basically, Kelly Blue Book is also saying lots of car inventory, same thing. And I think in this article, they're actually predicting that despite more discounting, they basically said that there's going to be more discounting. One of these guys said that. So, I want to just point that out. Basically, they're saying that there's going to be car prices coming down. So I've been beating this horse. I'm not going to do it anymore, but I want to just make clear there's a lot of evidence pointing in this direction here. All right. So what does all that mean in some ways? Well, what's interesting to me is that we start to look, now let's go back to some of our other workspaces here in the TradeStation platform. I'm going to put this back. I'm going to get rid of this trend line and put this back the way it's supposed to be, which is an hourly chart. I'll tell you, the one thing I do struggle with is I end up with too many charts in too many places. And so I'm trying to kind of limit that. So basically here, as we kind of dig through and look at things, I'm going to just jump to like the main thing I want to show, which is how do we find some of these companies that have been kind of, moving. And what's interesting to me, this is like Foot Locker. It's an example of like these sort of unusual things, like the retail stocks, things like Gap and stuff that have been coming off the lows. But I want to just show you, there was a tool we had used before in our old, this is the MT main from November. There was a tool we had used previously, but you guys still have it in your zip file. If you go up here to the top of the workspace, here's a zip file with a bunch of tools you can use in the TradeStation platform. And we have something called in-range multiple days. I probably need to hire a consultant to come up with better names for my indicators. However, it is what it claims to be. We're going to go to radar screen here, and here's what we're going to do. We're going to first load our radar screen. We're going to bring in the S&P 500. We're going to change the time interval to daily. And we're going to go to studies. We're going to go to this indicator, which you guys have from the workspace, from the ELD file. We've shared this with you in the past, so you will have it in range multiple days. I'm going to add that. What does this thing do? This finds a company's price range over a certain period of time. And I'm going to just make the font bigger for you guys. Okay. So what does this do? This basically, we're going to get rid of bid and ask. We don't need them for this. Even volume. So this indicator, it's loading the values. And just to make it work, I'm going to just force it to do what I want right now. I'm going to just change it right now. I'm going to right click on it, go to edit in range of multiple days for all symbol. You can see that the study period is set to 10. I'm going to set that to 63. All right, hit OK. I'm also going to add market cap. I'm going to go to studies and add market cap. And what this is going to do is this is going to allow us to find stocks that are moving now. And that while this is loading, I'm going to jump back over to some of the other things I wanted to show you. Over on our MT main, we're going to go to our radar screen. And we're going to go to our key ETFs. And we're going to look and see that, for example, this is going to show us in the last 2 weeks, the strongest has been metals. Interesting. We can see the financials outperforming in the last 2 weeks. Financials are up 3%. The S&P in the last is up 1%. Metals are up 5%. Software isn't doing well. A lot of that was coming, because of things like CRM. Software stocks have done pretty well. But we're starting to see, it's pretty interesting to me, is the growth versus value, IWD versus IWF. The value is starting to outperform. So there's been this idea of the mega cap, Magnificent Seven leading the market and all of that. And, I think that there has been an argument for a while that that people are going to rotate into other areas of the market. And you keep hearing this and it just never happens, I'll be honest. But here's the thing. We're entering a new year, nearing the end of a quarter. And also we're in a new environment. And I think that's the important thing to remember. We're now in an environment where inflation is coming down. The Fed is not going to be hiking. So that actually does create some potential for a different sort of setup. And so I think right now, we're starting to see some areas doing well that had not done well before. Like, for example, in the last month or so, the top performing member of the personal technology has been the best sector. But then you have real estate investment trusts and you have financials. So right over here, this column shows our year-to-date performance. You can see real estate is basically unchanged through the year, but they're up 12% in the last month. Financials are lagging the market by a pretty significant factor. All of their gain for the year, 4%, all of it has occurred this month. So basically, you're seeing financials and real estate investment trusts in particular gaining some strength. You're seeing things like metals gaining some strength. So I think it's interesting to see this. You're seeing gold miners gain some strength. Now, I don't want to get to it yet, but I will mention silver. We had talked about silver, and it's doing kind of what it looked like it was wanting to do. And we can mention that briefly. But the key thing here is that if you look in the last week or so, you can actually see semiconductors are lagging. Growth is lagging. The Qs or the Nasdaq are lagging. So, this narrative is potentially kind of coming together. 1 or 2 weeks of underperformance doesn't, mean that this trend is definitely taking shape. It doesn't mean they're going to, lag. But the fact is that if it does start to happen, let's look for some of those names. And I think, it's just important to realize that what we have seen right now in the outperformance of large cap technology stock is a historical aberration. I'm going to use TradingView real quick. Let's look at NDX divided by SPX. So you can do this easily on TradingView. You can basically see that the Nasdaq's ratio against the S&P 500 is really at something of a historical high. It's back to levels, where this is the relationship of one index against the other. So what it shows is this is not something where necessarily the trend is your friend. It's often a mean reverting thing. Now, if you look at the Russell 2000 against the S&P 500, you can see that it's really at the lowest level since early in the century. You look at something like the Dow, which has been playing catch up here. The Dow against the S&P. I haven't looked at this recently, but it's also pretty much at a long-term sort of period of lagging here. So this says that there is potential now for that rotation to happen. So if that rotation is going to happen, let's find where it might be. The other thing I want to quickly show, if we use the MT sectors workspace here, we have the SMH against the S&P. Now, this ratio has been at a very high level for a long time. So I wanted to also point this out that, if we start to see some weakness here in the semiconductors, they're at a spot where people can make the argument that they are as rich as they're going to get, or that they're fully valued, or that there's better value somewhere else. But the key thing is, based on this is the ratio of the SMH versus the SPY. It shows the two up here, and then this is a ratio on a weekly chart. You can see again that there's an argument that this is now an overvalued area. So that includes NVIDIA, AMD, the big software. These are more of the sort of big growth names. The other thing I just continue to say is that China remains, a weak spot. And if there is further deterioration in China, on top of that, geopolitical risk in China, those things become, risks that can hit the chip space in a way that they cannot hit the real estate space. They cannot hit the financials. And I think that's the key thing here, is it for people looking for opportunities in terms of things that can go right or can go wrong. You look at the chips, a lot of bad things can happen in the chips. China can weaken. You could have, other issues. You could have another, trade restriction put on chips or something, and more trade issues. But you get financials, and then you consider the things we've been showing about inflation, interest rates coming down. It seems to them more in a spot where the risks are switching in that direction. The market can envision, there's more likelihood that maybe things are going to go right for financials and stop going so great for chips. And so I think right now, especially as we near the end of the year, those are some of the thought processes happening for big investors. So let's go back now. All of this data will have loaded. I'm going to quickly bring in a chart. I'm just going to do Control-Alt-C, create a chart. I'm going to do a really quick symbol linking. Let's set this up on a daily. And what this is going to show me, I'm going to do just a simple green. What this shows me is stocks that are pushing highs of the last 3 months. So it's interesting. This indicator now shows me we're looking at a 63-day period, and it shows that these stocks are at the top of their 63-day range. American Express, for example. American Express at the top of its range for that time frame. This is another insurance company of some kind, GL. Lulu. Now, this is one we had done an idea on TradingView not that long ago. And again, this is a kind of traditional retailer. It's kind of an unusual name. It's not exactly the same, but to me, this is one that's been very interesting. And if you look here on our, if you go here to our rundown, you can see that we did an idea on Lulu a couple of weeks ago. Where is it? Lululemon could be running. And we had basically looked at this support level across here. I hadn't even looked at this stock in a few days, maybe a few weeks. But we had basically done the idea when it was down here, held this old level. And if you look over here, you can see that there are some other indicators in place. MACD had turned up, and now we're getting that continuation. But look at these other names: Travelers, United Healthcare, and Northern Trust Bank. This is an industrial, Xylem. So you're really seeing here that these are not, big names. Look at the market caps. There's only one of these that's over, that's close to $500 billion, which is United Healthcare. But I don't see any there's no Amazon, there's no Apple. Let's see where the big guys are. See, now we sort them by market cap. Apple's at 70% of its range. Microsoft's at 78%. Tesla's at 10%. So what you're seeing is the mega caps here on that kind of intermediate to short-term time frame are lagging. They're not pushing their highs. And I find that sometimes in environments like this, these are the names that they start to run, and then you might see the continuation in these. So I think it's important to realize that this is telling us something. So this is in range multiple days. We're using it on radar screen. You can also use it in scanner. So let's go now very quickly. We're going to go to apps. We're going to go to the flashlight for scanner. By the way, this is down here at the bottom of our workspace where we have our using the platform section. So I'm going to just very quickly create a new scan. Also, it's not, I think over here I have here's a scanner I'm going to just create it over here because I have bigger font on this one. And I'm going to just go create a new scan. I'm going to just give it today's date. That way I don't get confused and lose track of it. Because sometimes with scanner, you create something and then it's hard to find after. So I'm giving it today's date. I'm going to include all symbols. Oops. I'm going to go to next. I'm going to market capitalization. I have this built in as a default of $1 billion, 500,000 shares a day. That way I'm not getting random smaller stuff. And then I'm just going to go here to, I'm going to add, I'm going to go to indicator. We're going to go to in range multiple days right here. Hit OK. And then I'm going to change my time frame from 10 days to 63. Okay. And then I'm going to say greater than 0.8. Now this does take decimals. So 80% is 0.8. And I hit run. This is going to take a while, so I'll put it back in the background and go back to some of the other things in my rundown. Okay, so talked about these issues with oil and energy. What's interesting is something else, and we had talked about this before. What happens when Christmas comes and Black Friday comes and people's gasoline prices are 15% lower? I mean, this is what we said, and here we go. Of the 3 reports I've seen so far, all 3 were pretty strong. National Retail Federation, MasterCard Spending Pulse, and Adobe Analytics all showed record spending between Black Friday and Cyber Monday. Now, we're getting some Fed speak today. You know, Mr. Waller was surprisingly dovish. I almost wonder if he made a mistake by how dovish he was. But he basically said there's no reason to say we need to keep rates high. I mean, it was a really dovish speech the guy made a few days ago. Michelle Bowman and Thomas Barkin were more hawkish. Today we had John Williams being kind of middle of the road, basically saying he said there was a significant decline in inflation, but then he also said we need to keep rates high. Again, they're going to keep saying this until they see that PCE going to 2% on a year-over-year basis. But like I said, these forces continue. The market is a forward-looking thing, and it sees them. That's why I look at the countdown to the Fed. We now saw just in the last week alone, the market is now basically going to see a potential rate cut by May. Now, I'm not saying this is going to happen, but again, it's showing where the thought process is now. I also thought it was interesting. I did not have a time to get this, but what was interesting, well, this was during Thanksgiving week, so we didn't. I can't remember when it came out, but it was pretty interesting. It might have been on Black Friday. If you look at this report from the SPGI, I actually have it. Let me grab it on my other screen. I'm going to give it to you guys. It was stunning, in my opinion. Now, remember, what's interesting about this is going to be our first read on November. Okay, let me get this. It was on Black Friday. SPGI. Here we go. Should have had this. All right. This really was a stunner, in my opinion. And these are fast moving numbers, and this is not the official government employment report, but it's still interesting. Private sector employment in November fell for the first time since June of 2020, and that's interesting. Now, remember, we are not seeing any November data yet on these things. Like the PCE number that came out today, that's October. Right. So you got to remember that data comes out at different times. So you have to really think, what's the month that we're actually covering? So for November, one of the first major reports on November showed unemployment falling, cost pressures softened. And on top of that, you have this interesting thing of manufacturing firms. Basically, what did they say? They said something really interesting about efficiency. Manufacturing firms noted greater efficiency in production. Okay, look at that. So this is a pretty interesting one. I'm going to put this into the chat. This is from S&P Global. This is the old PMI report that I don't know who came out with this, but this is this is a purchasing managers index. There's several of them. The Institute for Supply Management numbers, they're going to come out. The first read, manufacturing, comes out tomorrow. But aside from that, these are not market movers. But what I just will continuously say is, we have to remember that these numbers saw inflation back in late 2020. They predicted everything that was going to happen before the official numbers. ISM is a big one, and that's what we're getting tomorrow morning at 10 a.m. This one came out on Black Friday, but it's similar to ISM. So again, these guys have been showing, these PMI reports have been showing weakness in hiring, slack in all these things with downward pressure in prices. So to me, all of this remains, again, part of the deflationary narrative. So precious metals have been strong in the last week. Real estate investment trusts, financials, very interesting. Yesterday was a pretty big day for financials. When I did this, let me look over here at my sector performance because we did see some real strength in the last month. Here we go. Yeah, home builders, ITB are the leading industry ETF that I track here in the last month. We had talked about the fact that the home builders remain at a spot where people can look out into the future and see the potential for significant demand. Today, we had very weak pending home sales because there are no houses. And as interest rates sneak down, there's going to be significant market share gains by builders. Traditionally, I don't have the numbers, but traditionally, you have most sales are existing home sales and new home sales are a relatively small chunk of the market. That proportion has gone up a lot in the last year or two. So again, doesn't matter who you are. If you're gaining market share, that's almost always going to be a positive for margins and for pricing and for demand. They can control their prices. And you know what? If the prices aren't where they want, they're like, yeah, we're just not going to build. We're going to wait until we make money doing it. Home builders are in that spot right now. And I think we just need to kind of bear that in mind, is that this is an area that is, it's outperforming, and we've been talking about it, and, let's keep it on our list. But they've been outperforming the last month. Energy continues to lag. It's interesting. It was the only major sector that had the 8-day exponential moving average under the 21-day when I did this yesterday. Also, Chinese stocks, FXI. In my view, this is now, we need to just realize that, China might be at a spot here where it really breaks to the downside and just really does. When you have a debt crisis like they have, the weak economic data, everything else, from my view here, this could be, continued sort of trouble with the Chinese sort of, overall market. Some of the individual names have done very well, like PDD had very strong earnings, has been a very strong stock. There are a few that are doing very well, but overall, China here remains in a very heavy spot. And for people looking to the downside, FXI, if it rallies back up to the 50-day, gets back near the top part of the Keltner channel. Remember, we do have that Keltner pullback tool that we've shared with you guys that allows you to see when stocks are at the high end of the Keltner channel. That might be some people if they're looking for the downside. For example, if you go over here to the price grid, we have our somewhere here we have our Keltner pullback tool. At this moment, I'm not sure where it is, but I will share it in the future. Let me also just briefly show you. These are the standardized returns, some of the ETFs I talk about. If you are curious about these are ETFs. If you're interested in the disclosures or you want to read the prospectuses of the ETFs, you go to the bottom of our rundown, and there's actually a link here to our disclosures page on tradestation.com. Wait a second, it's the wrong one. It's this one. This one. ETF disclosure page of our different ETFs that we look at in market trends. Okay, so let's go back over now to our radar screen. And it ran our scanner. This shows things that are in range. Wait, oops, man, I messed up. I apologize. I had it running on, it should have been in range. I did the wrong, all right, I got to do that again. That was my error. I forgot to change it. It has two outputs, and I had it look at the wrong output. So it's running again. Sorry about that, folks. This is still going to find a similar sort of thing. It's going to allow us to look and see, here are companies pushing the highs. By the way, T-Mobile. It's interesting to see this here. This one is pushing the highs. If you look at T-Mobile, let's flip this over to a weekly chart because T-Mobile is now, I've been watching this as one that is potentially setting up for, it's a little bit of a long-term traditional cup and handle breakout. This is, cup, handle. It's a longer-term sort of pattern, but if you look at it back here, had this rally out of 15 into 17. This period of consolidation made the higher low, and then it advanced. So I think T-Mobile here, it's interesting to see it pushing these levels. I was looking at it recently and seeing that. Let's go back to our daily and JP Morgan right here. Speaking of JP Morgan, let's jump back over quickly to TradingView. because our ideas on TradingView today, we did a special, we did an idea looking at banks. This is Bank of America. And if you look, there's several banks right here that have been breaking. So this is PNC, Key Corp. Again, the banks here to me are what are really kind of grabbing my attention because, you know, if the whole kind of mess and the storm of fear that you know blew up back here, let's look at like a Bank of America. You know, when we had our Silicon Valley, you know, blow up. If that storm is totally in the rearview mirror, and you see this falling trend line, breakdown through that trend line, you're looking at a sector here where interest rates easing lower if they do continue to move lower, and we don't have more blowups. A lot of these guys trade at valuations now where, like I said, people could make a justification for long-term sort of entries. And the other nice thing about these banks is they trade a lot of options. So some of these stocks, there can be a lot of sort of opportunity for options trades in these names. We had talked before about Citi, and, you know, kind of idea in this was to consider selling, you know, people said it might be a possibility to, you know, we could sell credit spreads underneath. The idea was when you had this period of consolidation, selling credit spreads underneath would let you potentially get assigned shares on a pullback at a discount while simultaneously letting you collect some premium. If you spent money on calls here, you would have lost money even from the stock moving higher. And that's a tricky thing when you have this sort of setup. But with some of the way these guys have been moving higher, some of them have that potential for, you know, potentially still selling credit spreads underneath them. The reason is that spending money on premium for something that faces some bearishness, if it decides to pause for a week or two, your calls can die. And if it does have a kind of pullback, it can basically set up an entry for you where it might fall and you get assigned shares, but at the same time, it was already something that you believe are in an uptrend. So if you have that sort of view, when something is fighting off lows like this, spending money on calls can be difficult. But having credit spreads underneath can allow the potential for making money on the upside, well, collecting premium if the stock just chops and keeps moving higher, or getting, you know, shares on a pullback without having to worry about actually buying them. So it's a different approach. Normally we think about calls and puts to get directional moves, but sometimes selling credit spreads in a directional move, in the context of a directional move, not a neutral move, but a context of a directional move, can still make sense when you have a challenge chart, which this is. You know, at the time I was mentioning that last webinar, we did have, you know, a falling trend line, but now we're breaking that. So I think it's just interesting to look at some of these financials here. But these names, look at like, wow, look at Discover. Look at this gap in Discover. I'm just looking at some of these now. Wells Fargo. I mean, I think it's important. How do we find them? We use in-range multiple days as a custom tool or a custom indicator I created on TradeStation. It's available to people who, you know, just want to come on. If you have a TradeStation, you know, platform, you can grab this for free off of the blog, and, you know, this is how you basically use it. Let's see if the scanner. All right, now our scanner is done, and this found a bunch of more stocks. The nice thing about this is I set it so it only shows stocks that are 80% in 80% of their 63-day range, which means they're at the top of their range in last month. And you can just kind of look down the list and find some individual names along here. That was how you do it in Scanner. I apologize for doing the wrong input. Remember, when you put an indicator in, it has different outputs. This one outputs days and in range. We want an in range, right? The mistake I made. All right, so if you look right here, you can see that this same thing, days, it just shows what my time frame is. I created it so it allows me to see, oh, am I looking at a 10-day range or a 20-day or whatever. So this tool might be useful. Now you can change it. You go in here and you go to studies, you go to edit, you can change it to 21 days, which is a month because we're looking trading sessions. You can change it to whatever you want. It's approximately 21 trading sessions in a month. So usually that's how I just do it. This is a real simple sort of way to approach things, but I found it to be useful to use this tool especially when you're in the kind of churn of a market like this. The thing is that there's not a lot of people who are long-term longs who are sitting on gains in these names, which means that there's not that natural incentive to be taking profits quickly. All right, let's see. These are most of the things I want to talk about. Oh, let me just quickly look at. I think we, very quickly look at the dollar index on a weekly chart here. These are some markups I had done before, which are now kind of irrelevant. You could ignore those. But the key thing is a weekly chart has been trending lower. From my perspective here, if you look at the dollar index on the long term, let's just make it even like a monthly long-term chart. If you look at this, this was the high of last year. There's an argument here that there is significant space to the downside. I mean, basically, at the beginning of the bear market, the dollar index was down here. We're basically, and then when the Fed started hiking, it went shooting higher. But the fact is there's space to the downside here in the dollar. And if that's the case, it creates a potential for opportunities in things like silver, which we had talked about. And let's put our indicators back on, because we had, like, on silver, we had talked about this falling wedge, and we've gotten that breakout from it. So in my view here, you look at silver and gold. These are areas now where I have some things drawn on here, but it held a 50% retracement, and basically it broke this trend line. So this is another idea I did on TradingView. So I just want to point out here, if we really are in a period where the dollar drags lower, it creates opportunities in precious metals and things like that, and in certain global stocks. I mean, look at UBS. I mean, no one talks about these European banks, but UBS, Santander, Banco Bilbao Vizcaya have all been taking off. Again, these are names that, they're now extended, but these are weak dollar names. So I want to just kind of, talk about some of these, because if we're in a period of a falling dollar now, it creates a new environment. The VIX also here, if you look at it on a weekly chart, we are back to these levels from before COVID. And at this point, with this thing, we could just see likely just to continue kind of sitting here and not a lot of significant moves, little blips up. But in many ways, the structural sort of argument here, especially if we have a 0%, print on CPI, that structural argument of higher volatility does fade, especially when we go back to our other point about soaring, money market balances. Wait, before I forget, I want to mention, here's something from S&P Global. And they talked about how banks are now starting to see improvement in their lending margins. So again, financials, this thing pops up. This is the same thing as like the car story where, Mannheim says this and Kelly Blue Book says that, and the guys on YouTube say this, and then the CPI report says that. They're all separate and they're all singing or barking up the same tree. We're starting to see that now. We're seeing the price action on our TradeStation platform using radar screen with our custom indicator in range multiple days. We're seeing it in the price action of the breakout of the trend lines. We're seeing it in these things from S&P Global. So again, when these things all start to independently pop up, that's what the beginning of a trend often looks like. This is the nowcasting. I talked about that. All right, these are most of the things I wanted to cover. I will very quickly mention here that we were looking for, we always have a mover of the week, an interesting sort of name that is off the beaten path. And the one that popped up for me was this company called LRN Stride. This is a company that appears to, they do some kind of educational technology. But apparently, there was a huge thing that happened in American education during COVID. If you think about it, I mean, it's possible. I don't have the numbers in front of me, but it's possible that American public education is the biggest industry in the entire world. We don't think about it as an industry because it's government and it's multiple states and counties and school districts. But you're talking about something that employs a huge chunk of the American public. It collects vast amounts of taxes. It spends huge amounts of money. And here you have a company that is a $3 billion market cap company, or $2.5 billion, that is somehow catching a piece of that spend. There is a secular change because of COVID. And I would also add that simply because of things like people, of things like AI and a million other things. There are going to be changes in how education works in this country. And if a company like this seems to be capturing a piece of that, somehow they're getting in. I haven't, and I'm sure it's very complicated, but it's interesting to look at this. So just take a step back and think about what I just said. Education is a multi-trillion-dollar industry in the United States. And here's a little company that is $2 billion jumping in and finding a way to get a piece of that. What does it mean? It means that their growth potential is potentially large. And that's what we're seeing in this movement. So I wanted to point this out because there's a company that's not in the S&P 500. We look for companies. We use a special scan to go back to a previous webinar. We showed you how to find these stocks that are moving on high volume, that are not in the indexes. The idea is to look out into the future and say, what will be one day a company that is a major company? And that's what we look for. I wanted to identify this one. There's a few others popping up. Next week, we're going to have another one on market trends. But LRN Stride was the one for this week. Tonight, we have Dell report earnings and Ulta Salon, ISM in the morning. And then it's a pretty quiet sort of set of data until the 8th when we get GDP. But remember, mark down the calendar, I think the 12th, the 13th, you get that double back-to-back data of CPI and the Fed. Those are the big items hanging out there. We'll be back next week, same time, 2 p.m. on Thursday. Hope everyone has a great day. Go to tradestation.com. Check it out. Thank you very much, guys.